Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today what we're going over is my stock market prediction for 2021. There's a lot of predictions being made out there, and in my opinion, I think no one really knows what's going to happen, including myself. So I thought what would be fun in this video is that since I never try to predict prices, is that when we look at all my companies that I currently own, out of all 24 of them, I usually don't try to predict a price. I don't say this company is going to be this price by next year. This company is going to be this price by 2 years from now. But what's fun to do every year or so is to look and just try to give a reasonable guess where the stock market is going to go. So just know that I'm a dividend investor. I focus on my annual and monthly dividend income right here. These are the charts that I follow, and this main one right here is the one that I care about most. So I don't care if my portfolio goes up next year. I don't care if my portfolio goes down next year. All that I really genuinely care about is that this number goes up. But like I said, I'm just going to give a rough estimate, and I'll go ahead and give you my target price right now. So my 2021 stock market prediction is that on December 31st of 2021, the S&P 500 index will end at 4,000, which means the SPY will be 400. The reason why I picked 4,000, I'm about to go over all in this video, and I will give the bull and the bear case for the S&P 500. And just so you know, those of you that don't know, as of December 24th on Christmas Eve, like I said, we have a few more days left. After the couple of days, we'll finish right around 3,700, okay? So that said, I'm implying about an 8% upside from where we're at right now. And I don't think that's going to be a huge year either way, one way or the other, because there's a lot of factors pointing towards it being bullish, a lot of factors towards it being bearish, and honestly, at the end of the day, myself included, no one knows what's going to happen. So I'm going to give all my bullet points. I'm going to show you a price return from 1922 to 1932, a reason why I picked those years. Trump did just sign the virus relief bill. We'll be talking about that. We'll be talking about the United States GDP coming back at record numbers. And also just a little tidbit here. We'll go over Wall Street and how they begin trading water futures and how that might affect the market. But anyways, guys, it's going to be a fun one. If you haven't subscribed to the channel, go ahead and do that. I'd invite you to do so. And if you want to use the brokerage that I'm going to be showcasing in this video, it's absolutely free with an incredible interface and some incredible features. It is growing and expanding at record levels. And if you want to sign up for the platform, you can do that by using my link down below in the description. And if you do so and deposit $100 to the platform using this link, you'll get a free $10, the easiest $10 you'll ever make. And then there's lots of other things to check out as well, including mentoring calls with me, Yada savings accounts, credit card referrals, and lots of other things as well. But thank you guys for tuning in, and let's go ahead and look at the S&P 500, looking at the ETF SPY. So when we look at this, 5 years ago, SPY was about 207, and then leading up into 2020, at the peak before the recession hit, it was at 338, about 340, okay? And then it went from 340, and then about 30 days later, it went from 340, here, let's look at the year chart. It went from about 340 all the way down to the 220s. That is a massive drop just for a 30-day span. And then ever since March 23rd, when the stock market bottomed, it's been pretty much nothing but up, 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 green after green day every single day since. And this has led to a lot of euphoria, a lot of panic buying, not panic selling, but a lot of panic buying. And I'm going to show you my main bullet points for a bear case and a bull case in my opinion. Now I have 7 bullet points here for a bull case, and I'll be going over them briefly right here. Number 1, you have the most obvious, which is stimulus. They passed trillions of dollars worth of stimulus to help aid the economy, to encourage spending, to provide some relief for some loans for a lot of small businesses, and lots of other ways that the federal government has helped aid this economic recession. Now, I wanted to show this, and this happened just now. I'm filming this on Sunday night. You guys should be watching this on a Wednesday. I know, a little bit early. But this just came out just a few hours ago. President Trump signs a $900 billion COVID-19 relief bill into law, days after he criticized the bill's $600 direct payments to Americans and suggested he may veto the legislation. So those of you that didn't know, he denied signing the bill previously, about a week ago, and the reason he did that is that he tried to push a lot of legislators to try to bump it up to $2,000 payments. I guess he backed down on that. So basically, everybody out there that is an adult and that is not a dependent should be getting a $600 direct payment. So good news for the economy. Once again, this is going to lead to higher stock prices now that we have just a free $900 billion out there into the economy. Now, we go back here. So you have stimulus, number 1. Number 2, you have low interest rates. I went over this many times in videos, and when we look at bond prices, alright? So what I have pulled up here, I have TLT. Now, this is a long-term Treasury bond ETF. And this Treasury bond ETF focuses on Treasury bonds that are 20 years plus, so 20, 30-year Treasury bonds, and these are yielding next to nothing. Right now, the dividend yield on this is 1.39%, less than 1.5%. And if you're a retired person that is trying to live on fixed income, you can't do it. So realistically, when you're trying to put your money somewhere, you're trying to store wealth, you're trying to increase your net worth, bonds are not the place to be. And pretty much any fixed income assets are not the place that you need to be, because any long-term treasury bonds or treasury notes are yielding pretty much nothing. So when you look at the S&P, the only opportunities you have is to invest for a hoping growing dividend yield through the form of dividend payments, right? Now when you have the S&P, it is yielding very low as well, but it's really the only thing that you can invest in, considering that it has growing dividend payments. And so a lot of people are basically being like forced to invest in the equities just to try to get some kind of yield, and this is leading to a lot of buying at increased asset prices. So low interest rates, that is going to be staying down probably for the next couple of years, according to the way that the Fed is talking about this. And obviously when you have low interest rates, that leads to higher asset prices because lending is much easier to get. Business can refinance loans at much lower rates, like I mentioned in my previous video with realty income. People can get loans without spending as much on interest, and that overall just leads back to more money into the economy. Now third, you have the vaccine. Now, I don't really know whether or not this first vaccine will be successful or not. I don't think it really matters because you have so many companies working on it. One of them is going to be successful. And if we can assume that at least one of these vaccines will be successful, which I think is pretty safe to say, then that is just something that you can say is a bullish factor for the market. One, not only for the economy coming back, businesses won't be shut down as much, but basically just some confidence in the market and some confidence for consumers. People will be more confident in going out to restaurants, which means they're spending more money. People as investors that are scared to invest because they're worried about the second or third wave of the coronavirus, they don't have to worry about that anymore because the vaccine will probably eliminate a lot of these future diagnoses. Now fourth, this is a little bit interesting, and this is something that we haven't really seen before. This is kind of nuanced to our situation, but we have the S&P 500 weighting, parentheses, tech companies. Now the reason I put tech companies in parentheses is that I want to go to M1 Finance here, and I want to click research, and I want to click stocks, and we're going to sort by market cap. So what we're going to do is we're going to look at the top companies. And as you notice here, it's pretty obvious to notice that you see we are looking at pretty much all tech companies, right? Apple, a tech company. Microsoft, a tech company. Amazon, tech company. Google, tech company. Facebook, yada, yada, yada. All these companies are tech companies. And what happens to these companies in a pandemic? They benefit from the coronavirus. Believe it or not, a shutdown makes these companies more valuable. And so that has led to these companies that already have a massive weighting in the market be able to thrive in a time where all the other businesses around them are dying out. So that has led to a massive amount of weighting being targeted towards these 4, 5, 6 companies. So that is leading to a really interesting scenario to where really the only way the market has any type of major downturn, some type of major crash, is to take down the tech companies. If some type of story plays out where the tech companies will likely no longer be as valuable as they are being valued at right now, that is really going to take the market down. But unless some type of negative catalyst is going to take down these tech companies, the market is likely going to stay as high as it is, or heck, probably even move a lot higher. Now, number 5, we have the economy bounce back. U.S. third quarter GDP growth revised slightly higher. And if we scroll down here, it says the U.S. economy grew at a record pace in the third quarter, fueled by more than $3 trillion in pandemic relief, like we talked about earlier. The government confirmed on Tuesday, but it appears to have lost momentum as the year drew to an end amid raging new COVID-19 cases and dwindling fiscal stimulus. Now, like I said, this was posted about a week ago, so we didn't have the new stimulus package yet. GDP rebounded at 33.4% annualized rate last quarter, and then it was revised up from the 33.1 reported last month. It followed a 31.4 rate of contraction the previous quarter, and the economy remains 3.5% below its level at the end of 2019. So when we look at these numbers, I know that it's scary to see GDP going up and going down, but you see a major bounce back here. Now, before I go any further, I wanted to mention this. You know how I said I don't like to predict prices? I'm basically a buy and hold investor. I mentioned in some of my previous videos I have my forever stocks, right? My companies that are included in that are Realty Income, are Johnson & Johnson, are 3M, are Pepsi, Coca-Cola. A lot of these companies are my forever stocks. I'm buying them, and I'm likely never selling them. And if I am going to sell them, I'm going to be holding these companies for 5, 10, 15, 20, 25 years, likely till the day I die, right? I'm not anticipating selling any of these companies. Now, when we look at this and we know that we're a buy and hold investor, that's the same way you should be approaching this. That no matter what happens with the vaccine, no matter what happens with the president, with stimulus, with anything you could possibly imagine, you should be buying and holding. And I'm going to give you a perfect example. So at the end of July of 1932, that was the absolute rock bottom price of the stock market after the Great Depression. Now let's remember in the Great Depression that the stock market fell for the S&P about 90%. I'm going to repeat that again. The stock market fell 90% in 1932. From 1929 to 1932, in July of that year was the absolute bottom. Now here's the interesting thing here. If you had been investing long term, now let's go back to say July of 1922, a 10-year span backwards. Now obviously, this is the worst timing ever. This is the worst case scenario if you could magically pick the worst time to sell. This is assuming that you didn't sell earlier in the year or later, a year later, 1933 or 34. The results would have looked much better. Now imagine if you bought and sold at the most horrible time. You were selling at the absolute rock bottom of the market, a 90% downturn. Well, if you've been investing for a 10-year span and reinvesting your dividends, this number right here that I'm highlighting, you actually would have had a positive return. Think about what I just said for a second. The worst performance that the S&P has ever seen, of 90% downturn, you're looking at still a positive return over a 10-year span if you're reinvesting your dividends, which you should be. Your annual return would be about 0.2%, and your total return in that 10-year span, while not great, is still positive. 2.187 over the course of the next 10 years, and that is a positive return. That's what you should be looking for. So don't really base all of this off your investing strategy. This is just the bull in the bear case. But number 6, we have euphoria / optimism fueled buying. When you have these prices at all-time highs, you have a lot of people that really, frankly, a lot of dumb money, just keep on thinking that it's never going to stop. That even though we're at all-time highs, it's going to keep on going to a new high, and then a new high after that, and then a next level, and then a next level, and people are buying basically just off of euphoria and optimism. And then number 7, this is the one bull case, and this goes for any market during any time in history. Basically at all times within reason, these companies, some of the greatest companies on earth like we showed in this list, in this little research tab right here, these companies continue to find ways to further their earnings growth, continue to do share buybacks and dividend payments and dividend reinvestments, as well as just basic innovation. Humans find more efficient ways to do things, and they find ways to continue to be more efficient in their companies and make them valued at a higher price. Next up, we have the S&P 500 bear case. I'm going to give some of my bullet points for this. The most obvious, we have higher unemployment. The unemployment rate is so much worse than what it used to be just a couple months ago, a year or two ago. Number 2, we have expanded multiples. And I think number 2 here, if there's any reason for the market to come down next year, it had to be for number 2. Expanded multiples meaning when you look at these companies, let's go ahead and look at Apple. A 39 PE ratio, extremely high. Microsoft, a 35 PE ratio, extremely high. And then Amazon, a 91 PE ratio, extremely high. You get the point. When you look at these companies, the PE ratios for a lot of the highest weighted companies in this index are being valued at incredibly high levels, being priced in at record level growth levels for the next couple of years. So these expanded multiples are likely to have a possible retraction. And if there's any reason on this list that the market would go down next year, it's definitely for number 2. Number 3, not just from the coronavirus, but basically just the way things have been in general over the last couple of years. Number 3, you have the looming national debt, right? The national debt is at tens of trillions of dollars. Who knows what that'll look like in the next few years, but that is never really a good case to have tens of trillions of dollars in national debt. Just another bullet point there. Number 4, evictions at record levels. So we know that the unemployment benefits only lasted for so long, and there's been a lot of protections for people from getting evicted from their houses and their apartments. But now a lot of those protections are gone or on the verge of leaving. So evictions are happening at sky-high levels, and that is not good for the economy. Number 5, people always like to talk about inflation, but actually what's a bigger risk right now is deflation. I know a lot of people are thinking, oh, the Fed's printing money, that's going to cause inflation. Actually, on the contrary, the biggest risk right now is deflation. You wonder why the Fed has been talking about leaving interest rates at 0% for 1, 2, 3, 4 years out into the future. The main risk is because of deflation. They're doing this thing called quantitative easing. And I don't want to get into that idea because that is a lot to explain, but basically, quantitative easing actually causes deflation, and as well as recessions, you have less spending. People are scared to go out and spend. They're hoarding cash. That actually causes deflation. So number 5, and I don't think it's a massive risk, but it's definitely something to think about if we had another wave of coronavirus. Number 6, interest rates have nowhere to go but up. Now, I know right now we're at zero interest rates. It's likely to stay that way for a long time, but the market is pricing that in for years worth of 0% interest rates. When they start going up, that makes money harder to borrow, right? If you're a consumer and you want to get an auto loan, that costs you more in interest. If you're a multi-billion-dollar company, like I mentioned with Realty Income, they couldn't have been able to finance that deal if interest rates were 2, 3, 4, 5% higher. So that makes it harder for businesses to make money because it's harder to lend money from banks. Number 7, you have election results uncertainty. Not only the president, but you also have the House and the Senate. I don't want to get into that, but basically, there's a lot of uncertainty in there, a lot of conflict. The nation's getting very divided. That's just one more piece of uncertainty added to the pie. Number 8, one that people forget about a lot of times because this was the main focus in 2018 and even early 2019. And people have been so focused on COVID that I think they forgot about number 8. There's still a possibility, especially potential change for presidency, for a trade war to happen. People have pretty much ruled this out. They put it on the back burner. They forgot about it. But the trade war is still a real possibility. It's still a threat. And number 9 goes hand in hand with number 8. Chinese stock delisting. There's been potential for these companies to be delisted off the New York Stock Exchange. Now, why that's important is that leads to more international tension. I don't really know what's going to happen, but it's definitely just another level of uncertainty being priced into the market, and that might be taking a big effect in 2021. Now, that said, like I said, I don't think you should be making any bets based off these assumptions because there will always be a bull case for the market. There's always going to be a bear case for the market. And trying to make predictions based off of this information is not a way to predict things. The reason I'm making this prediction is strictly just for fun. Why not? Who knows? Maybe I'll be super close. More than likely, honestly, whether it's upside or downside, I figure I'll probably be way off, but reasonably so. I think that it's okay and fun to just make a little fun guess. But last but not least, before we get off this, I want to show the last piece of news here. This is honestly, to me, a little scary. I look at this and I see Wall Street begins trading water futures as a commodity. Wall Street has begun trading water as a commodity like gold or oil. And basically, when you read into it and you read the reasons why they're trading it with futures, is that they're scared that the future scarcity of water is going to lead to sky-high prices. Now, as an investor, that gives you an opportunity to take advantage of the price of water, but the scary thing is that what does that mean for the human race? I'll let your conspiracy theories run wild. It's just a thing that I wanted to throw in here just as a bullet point for the video. But thank you guys so much for watching all the way to the end. I really appreciate it. I invite you to subscribe if you haven't done so already. But go ahead and sign up for M1 Finance like I mentioned at the beginning of the video and check out all the other stuff down below in the description. But thank you guys so much for watching, and I'll catch you guys next time.